Hi there. In this Borrow Smart lesson, we're going to focus on something that could be really an interesting opportunity, and we're calling it the second look advantage. The idea being that sometimes it makes sense to have someone else, another professional, review the work that either you're looking or a client may be looking at that could uncover maybe financially beneficial options or simply reaffirm a choice you've already made, giving you greater confidence in the decision making process that you're making. So let's take a look at this. At the end of the day, there's lots of lenders in the world, lots of mortgage companies, but not a lot of them really have the knowledge or expertise to be able to provide a very high level advice and to be able to really put together home loan strategies and plans that could work. Right at the end of the day, the mortgage process tends to be transactional rather than relational. Lenders sell products. Terminology can often be very confusing. I don't think anyone sets out to do harm to a consumer, but sometimes what you don't know can hurt you. The same can be true of advisors or anyone that's in a position of trust, right? And oftentimes, we find that other lenders just tend to be order takers, right? And at the end of the day, homeowners, consumers don't really have a framework to figure out, like, how do I really get different options and figure out how I vet a professional. So the risks are really threefold. You could make expensive mistakes on product fees and just the expense involved in the transaction. There could be missed opportunities because options are not presented that could cost financially over time. Then, of course, there could be structural mistakes around how it's set up, a mortgage is set up. So in any case, as with any serious illness, it's often wise to get a second opinion. The opportunity comes from our expertise as certified liability advisor, really. So the training that we go through is to analyze a client's financial and borrowing goals and present options that lead to achieving those kinds of goals. And in this situation, the second look advantage might provide a superior option with superior outcome. So you do a complete analysis, gaining confidence in the options already selected or new options, if there are such a thing, oftentimes leads to better decision making because maybe the client is unsure if there's something they're overlooking or missing, and this could lead to that increased confidence in the decision making process. And of course, analysis of different options can reduce stress and save time and second guessing, which is different. Now, if the current mortgage lender has done a good job, all at the end of the day, a second look is going to do is confirm that this is an acceptable choice and give them the confidence to move forward with that choice. And this is just sort of like we'd consider this additional insurance of having another professional review the work that's already been done. Oops. So really, this process prevents three kind of great things: avoidance of an expensive mistake, maybe missing opportunities that are out there, open the client to new ways of thinking around the finances, and then ultimately gaining confidence in their decision to move forward. And how does it work? Well, the certified liability advisor, our firm, goes through and reviews client objectives, all the different options that are on the table, analyze all the options available in the marketplace, determine which options actually meet the goals and the needs, present them for action now or potentially later, and then maybe there's a recommendation that no change is needed or consider a different alternative. So we're just going to briefly go through a case study here where a second look would have made a huge significant difference for this client who called to look for a home equity line of credit to build an accessory dwelling unit. Over the last couple of years, the client had been aggressively paying down their mortgage from $700,000 when they purchased it several years ago, all the way down to $300,000 currently. The home value has gone from $875,000 to $1,450,000, so a significant increase in home value, but also significant cash put into the property to pay it down, and at the very least from the most recent refinance, where the balance is already down at $557,000. So the goals were to build an ADU for additional income, build net worth over time, pay off debt, doesn't want payments. I was planning to invest another $75,000 in this ADU and borrow the $225,000 to finish the project through a home equity line of credit. it then became evident that what our plan for them was going to be take the largest line of credit they can have, which protects the equity in the home and gives them flexibility and safety and liquidity. Keep the $75,000 for liquidity for now, and then target a specific blended interest rate cost, because there may be $300,000 on line of credit at a high interest rate and $300,000 at 2.95. That blended rate might be eligible for refinance over the next 12 or 18 months. And so the financial results that could have happened, the $200,000 was paid down on the mortgage, simply growing in a low risk account would have been enough to pay off the entire mortgage in 11 years and 4 months. That would have been what we call the freedom point, or at least a freedom point in the case of mortgage freedom, enough assets in a side account to just pay off the mortgage, which would have been quicker than he would have gotten there anyway, or that they would have gotten there. And then that same money would have earned about $32,000 simply in a safe investment over that time period. Because by paying down the mortgage, there was no change in cash flow. All it did is reduce the term on the back end, which is potentially a good thing. But if the objective is growing net worth, holding that money in a separate account and letting it to grow through equities, in addition to the home appreciation, would have delivered higher net worth over long periods of time. And so at the end of the day, he would have had the cash to pay for the ADU rather than having to go out and borrow now at much higher interest rates. And so very simply looking at one piece of it, which is the ability that the $200,000 that went into equity on the most recent transaction would have been enough money to pay off the mortgage here at 11 years and 4 months. There's more going on in this case, but that's sort of the basic piece about it. So a second look can be very beneficial for consumers, clients, and our partners that work with consumers and clients. Thanks very much.